We've been talking about adjusting journal entries, so now let's go through an example. To illustrate the process of making adjusting journal entries from a trial balance and then preparing an adjusted trial balance, let's go back to that Circle Films example that we used before when we were doing individual transactions. So as a result of the transactions entered into by Circle Films during its first month of operations, we've got this trial balance that's shown here as of May 31st. So remember, the trial balance is just pulling all of those account balances over from the general ledger, and the debits have to equal the credits. So now let's go through some adjustments. On May 31st, Circle Films filmed the retirement reception for the customer who'd paid that $2,000 deposit on May 10th. So Circle Films has now filmed the retirement reception, so it no longer has a liability to that customer. It has a revenue instead. However, the trial balance still shows the $2,000 liability. So we need an adjusting entry to adjust the liability down and the revenue up. So that's adjusting entry number 1, which is for deferred revenue. So we're recording revenue that was actually earned. On May 31st, Circle Films filmed the first night of a 2-night local play. Now, of course, it goes over month end. So the second night is going to be filmed on June 1st, at which time Circle Films is going to bill that customer. The customer has agreed to pay Circle Films $1,500 for each night. The trial balance does not reflect this because Circle Films hasn't given that bill. Remember, they're not going to invoice them until June 1st. So the adjusting journal entry adjusts receivables and revenues up so that adjusting journal number 2, so this adjusting journal entry is for accrued revenue. So we're debiting accounts receivable and crediting service revenue. That's just for the $1,500 that they earned on May 31st. Now Circle Films has $650 in supplies on hand, but the trial balance shows $1,000 in the supplies account. And so now this gets a little bit confusing because we have an asset and an expense account for supplies. So that our trial balance is showing $1,000 in the supplies asset account, and that's the amount that Circle Films had originally purchased a little while back. So therefore, Circle Films has used $350 in supplies because we said they've got $650 now. Their books say $1,000, so that must mean they've used the difference, which is $350. So this adjustment is a deferred expense and must adjust the supplies account down from $1,000 to $650, and then you record $350 in supplies expense. Adjustment number 4 is because Circle Films has to pay interest on the promissory note. So remember, they bought some more equipment and you signed a 2-year, I believe, promissory note. That was at a 6% annual rate. So after 1 month, they've incurred $45 of interest expense. That's $9,000 times 6% divided by 12. And this expense and the related obligation are not reflected in the trial balance because they haven't yet been recorded. So our 4th adjusting entry is an accrued expense, which decreases equity because it's an expense, and it increases liability because we're liable for that interest. On entry number 5, Circle Films estimates that depreciation for May on those 2 cameras is $600. So this deferred expense adjustment debits expense and credits what we call a contra asset account. So accumulated depreciation is a contra asset because it goes against an asset account. So here's what our income statement is going to look like. Once we get all the revenues and expenses recorded and that adjusted trial balance prepared, we can produce financial statements. So first we're going to do the income statement, and that's what we see here. And with our net income calculated, we can pull that over into our statement of retained earnings. So recall that the statement of retained earnings takes the beginning balance in retained earnings, and remember this is a brand new company, so we've got a zero beginning balance. It adds the net income from the income statement, and then it subtracts dividends to yield the current balance in retained earnings. So Circle Films May 31st adjusted trial balance shows no balance in beginning retained earnings and that $1,500 balance in dividends. So their statement of retained earnings for the month looks like this. So finally, once we have retained earnings, we can put together the balance sheet. So let's just wrap up this discussion and talk about the closing process. After the financial statements are prepared, we conduct, or companies conduct, this closing process. The closing process is the process of transferring all revenue, expense, and dividend account balances to the retained earnings account. So we're basically closing out those accounts to retained earnings. So you reduce all the revenue accounts to zero, and we use retained earnings as that offset account. So here's an example. Revenue, expense, and dividend accounts are what we consider temporary accounts because they only accumulate balances for the current period. After the period ends and we create the financial statements, all of those temporary accounts are zeroed out for the start of the next period, and their balances are transferred to the retained earnings account. So here we show that we've got 3 journal entries that we need to use to complete this. First, we have to decrease the revenue account to a zero balance. That's the service revenue of $8,500, and it's debited. The revenue account is debited, and the retained earnings account is credited. Our second entry is that we decrease the expense accounts to zero balances. So the expense accounts are credited, and the retained earnings account is debited. And then finally, we eliminate the dividends account by debiting retained earnings and crediting dividends.